Okay, so the previous 2 weeks, we've discussed order blocks and imbalances. Now for the next 3 weeks, we will cover Wyckoff schematics. Okay, Richard Wyckoff was a trader from back in the day who discovered, some significant moves that the market makes. And so they've basically coined it with this name. There are distribution schematics and there are accumulation schematics. And that will let you know as a trader what direction the market is heading. And it would also give you a reference point on where you can enter the trade, to catch your pips to go in the correct direction. Wyckoff can be a little bit confusing. So, it's important that you allow the schematic to develop fully before you, basically try to break down what you think you're seeing. I guess the most important thing that I can kind of relay before you watch this video is that the markets are fractal, and you'll hear people say that, but basically that means that the same thing that you see on one time frame, you're going to see on every time frame. It doesn't matter what time frame it is. You'll see Wyckoff play off on the 1 minute, and you'll also see it play out on the monthly candle. Okay. The difference is it happens very fast on the 1 minute, and it happens very slow on the monthly. If I remember correctly, it takes about 153 candles for a Wyckoff schematic to play out. But don't get caught up on all the intricacies as you start your journey. Kind of look at the overall picture, make your determination of what direction that you think the market is going based off of what you're seeing, what's being manipulated. Are the highs being manipulated, or are the lows being manipulated? So the video that I like watching is by a guy named Pips of Persia. He has a very thick, like London accent, but it's a recorded video, so obviously you're going to have to kind of revisit what he's saying, and he brings some great points forward. So let me go ahead and pull the video up, and we'll watch the video. It's about 30-minute video. So at the end of the 30 minutes, I'll answer any questions. And, with this short group, maybe we'll get out of here a little early this morning.
Good morning, good afternoon, good evening, traders. Wherever you are in the world, I hope you're doing well. I hope you're safe. I hope you're healthy. I hope you've got a big smile on your face. And I hope you're catching pips as usual. Pips of Persia here. In today's video, we are going to be speaking about some basic Wyckoff concepts, because I know a lot of people who are plugged into the videos in this channel might not necessarily know what Wyckoff is, who Wyckoff is, and how we use Wyckoffian concepts to analyze charts and find out potential market direction. So today we'll look at some basic Wyckoff concepts to strengthen the core knowledge that you should all have. And in a future video, in the part 2, we'll speak a little bit more on an advanced level about how to actually apply Wyckoff concepts to the charts. So let's go ahead and jump straight into it. Now, I know a lot of people watching this channel already know what support, resistance, and trend lines are, but I think it's crucial for us to recap very quickly to understand how majority of the traders in the world are actually executing trades based on a zone of support, a line or a zone that the market keeps bouncing up from. And the attitude is, hey, next time that we approach that zone, we can look to buy it. Vice versa for a resistance, where we are keeping below a certain line or a zone And whenever we approach that given line or a zone, a lot of traders are looking to short sell whatever currency pair they're looking at. Similar idea with trend lines, where people would see rejections of a trend line and decide to buy it or sell it at potentially the third or the fourth touch of that given trend line. So whether you're looking at trend lines or resistance or support or whatever other concepts that you're looking at that fits into these 3 points, you have to pause, take a step back, and understand the core difference between support, resistance, and trend lines and any other institutional concepts. Support, resistance, and trend lines have always been taught in a definite way to execute trades. And what I mean by that is you have been taught whenever it touches a support, definitely buy it. Whenever it touches a resistance, definitely sell it. Whenever it touches a trend line, if it's a third touch, for example, look to buy it in an uptrend line. And if it's a third touch in a downtrend line, then look to sell it. Whereas when you look at Wyckoff concepts or other institutional concepts, this is not necessarily the case. We do not draw conclusions based on one simple line. There's a lot more that goes into the analysis. So put support and resistance and trend lines out of your mind. Put what you know about support and resistance and trend lines out of your mind for this specific training for Wyckoff to make a little bit more sense for you all. Now let's speak a little bit more about the actual manipulations when it comes to support and resistance and trend lines. The question is, do the large institutions such as banks actually trade using support and resistance and trend lines? Are there people sitting in the bank's trading floor thinking to themselves, oh, look, the market approached the zone of support. Let me put 1 million lot sizes and look to buy this now. I really doubt that that's how the big institutions are actually executing orders. And if that is the case, us as retail traders, as people who are trading with our own capital, we have to take into account how the larger players of these markets are actually executing trades, because that's when we will have the highest probability of being on the right side of the market. Are the markets manipulated? This is a question that probably every trader at some point in their journey have asked themselves. And a lot of people are still uncertain whether or not the markets are manipulated. Now, the term manipulation in general is a very aggressive term, to be honest with you. As I've explained in other videos, it's not the fact that the institutions are sitting there thinking to themselves, oh, this trader is looking to buy this, let me manipulate them out of their trade, or let me do this and let me do that. It doesn't necessarily work like that. It's not really manipulations. It's a matter of where liquidity is and where the institutions have to push the market to for them to take other traders out of the market. But there's a good reason why they do that. And I'm going to explain this in the most basic way I possibly can. Think about it like this. Whenever there's a large amount of orders in the financial markets, and let's assume all of these orders are in the same direction. For example, there's many orders buying into GBP USD. This, in a way, takes up a portion of the financial markets. At the end of the day, the amount of money that's actually being traded every single day, although there's new money being printed every single day, the amount of money is finite. So when there's a massive amount of order in the same direction for a given currency pair, or for that matter in different directions, it's actually taking up a huge amount of liquidity in the financial markets. For the large institutions to now be able to open much larger positions, they in a way have to take the other traders out to release liquidity so they are able to open bigger orders. Now, there's a lot more that goes into it, but as I said, a very basic understanding of why the manipulations actually take place. And so you all know that this isn't conspiracy, this is fact. These happen on a daily basis. It's turned into conspiracy because a lot of people have always thought to themselves that, yeah, the big institutions are just sitting there as very bad people manipulating the markets left, right, and center. Let's be a little bit more logical with that thinking. So now the question is, can you keep yourself safe against the manipulations? Well, at the end of the day, this is the world of investing and trading. So more than thinking about how can we always keep ourselves safe against the manipulations, the major question is, how can we actually have a solid trading system in place that allows us to even lose, for example, 30, 40, 50, 90% of our trades, yet come out profitable at the end of the week or at the end of the month? That's when you're thinking as an investor rather than someone who's just treating this as a game. So let's speak a little bit more about how big money actually moves in the financial markets. Big money leaves footprints. That's point number one. If there are orders being executed worth hundreds of millions, and the orders in the financial market are much, much larger than that, we are talking tens, hundreds of billion, and even more than that. This massive amount of capital is going to leave some type of a footprint on the actual charts. And us, as people who understand some Wyckoff, or let's say smart money concepts, we can in a way spot these footprints and trade based on them. But what do I actually mean when I say footprints? Assume this. Let's say you are the owner of a massive company and you have many stocks and many shares within that company. And now you want to go ahead and distribute or sell all of your shares. Because you control such a massive amount of the shares of that company, if you just go ahead and short sell everything there and then, it's going to potentially result in a massive drop in the price of that given stock or of every share. So instead of you going ahead and selling all of your stocks there and then, you want to now think of a systematic way for you to sell here, buy there, sell a little bit, buy it back a little bit, in a way, keep the market going sideways or your typical consolidation. And once you have distributed all of your shares, then allow for the market to have the correct move or allow the price of those shares to have the correct move. Vice versa when you want to accumulate. Now, let's say you want to come back in and accumulate all of those shares again. If you do that there and then, once the prices have dropped, you are going to potentially cause a massive spike there and then. So instead of doing that, you need a systematic way to buy a little bit, sell back a little bit, buy here, sell there, in a way, keep the market again going sideways, consolidating, so the price doesn't change massively when you're accumulating and distributing, to then allow for the larger movement of price. What Wyckoff traders do is they look at zones of consolidation from a complete different perspective to the average person. The average person would see the zones of consolidation, and the example that I can give is this. The average person would look at the zone of consolidation as if, hey, the market is going sideways. If we start to break above it, then I'll definitely buy it. And if we start to break below it, well, I'm going to definitely sell it. There's other methods and other strategies that speaks about how you can trade zones of consolidation, such as if we are moving higher and consolidating, then this is most likely going to go higher. Or if you're moving lower and it's consolidating, this is most likely going to go lower. All of these, not that they are wrong, but they're very incomplete methods of looking at the markets. Because the entire point is if the market is already moving and trending properly, then obviously certain positions have already been executed. But when it's being kept going sideways, this is where we need to read into the price properly. And based on certain facts that we see, we can then determine whether or not it's more likely for this to continue going higher or lower. And this is exactly where Wyckoff comes into play. Now, who is Wyckoff? Wyckoff is one of the 5 titans of technical analysis, and his methodology, the reason I've put strategies in quotation mark over there is because it's not, I don't really like to call it a strategy or let's say pattern trading or anything like that, but his methodology, the way that he reads the market behavior has now been proven profitable for well over 100 years. Now, Wyckoff concepts were generally used for stock trading, and us as foreign exchange traders or whatever other asset classes that you are trading, we have to know that although majority of the concepts for Wyckoff will apply to every market, there are elements of it that we don't necessarily need to transfer to our trading. For example, us as foreign exchange traders, we do not necessarily need to look at the volume analysis behind Wyckoff, but I'm not going to go into too much detail about that right now. So the question now is, okay, amazing. We want to look at zones of consolidation from a complete different perspective, but how can we know where the big players are buying or selling? This is where different schematics such as accumulation, distribution, re-accumulation, and redistribution comes into play. So let's firstly speak about accumulation. In a future video, we'll speak about what all of these PS, SC, AR, ST, so on and so forth, or your preliminary support, sellers, climax, secondary test, and spring, what all of these actually mean. In today's video, we just want to get a general understanding of what an accumulation is. There are multiple different schematics for accumulation, distribution, re-accumulation, and redistribution. Again, we are going to be breaking these down in the future videos. Generally speaking, an accumulation is a manipulation of the lows and a break of structure to the upside. Another way to look at it is accumulation is to take out early buyers before the market has that rally higher. So the entire analogy behind accumulation is that we are indeed reaching below some previous zones of support. Multiple times we are manipulating the previous lows before we have a rally higher. And remember what we spoke about. The reason behind this is most likely there are a lot of people or a lot of even larger institutions that are buying this market at this zone of support. By reaching below that zone, we are taking them out of the market, therefore releasing liquidity to allow the bigger players to open larger positions. Hence why we keep reaching below the previous lows and below the previous lows before we continue higher. So let's have a look at an actual chart analysis that we have done for accumulation. There's many videos that we have spoken about in terms of accumulation. GBP USD, which is one of the recent videos, is available for you to go and watch and get a little bit more detailed understanding of these accumulations. But this entire box that I have marked up over here can actually be looked at as a zone of accumulation. If I want to go ahead and mark this up similar to the markups that we have over here, we can start off by finding that, okay, this is our seller's climax, and this is our automatic rally to the upside from there. Following this, we continue to manipulate the lows. Look at that. We've reached below previous zones of support. And again, we've reached below all of these previous zones of support, creating the secondary test in phase B and your final spring or the final push to the downside before we start the rally higher. Now, as I mentioned, an accumulation is a manipulation of the lows and a break of structure to the upside. So you always have to take into account, okay, we are definitely reaching below previous lows, but have we actually broken structure to the upside? And once the answer is yes, that's when your accumulation is going to be much more valid. This is a beautiful example of an accumulation, especially if you have watched the GBP USD video. This entire accumulation wasn't just there to manipulate all of these little lows. This accumulation actually resulted in also a manipulation of this trend line. A lot of people were probably looking to buy it based on this trend line. And once the market touched the trend line, they were looking to execute their buy orders. Surprise, surprise, they get taken out just before the market has its next rally higher, which resulted in this entire move to the upside. Talking a little bit more about this specific accumulation, this is where the larger institutions are actually accumulating their orders. In a way, this is an area of demand in the market where clearly we have larger players of the market looking to accumulate positions before this reaches higher. And once we can see these facts more clearly on the charts, and if this is confusing now, don't worry, you're going through the same process everyone else who trades Wyckoff went through, especially myself. It took some time to get my head around Wyckoff. Trust the process. But once we can see these facts a little bit more clearly on the charts, it allows us to have a much better chance of the actual direction of the market. Direction being the key word here. We use Wyckoff in a way to support our directional bias in the market. We don't necessarily use Wyckoff for entries. We have other concepts that we would use for entries. Now, opposite to an accumulation, you have a distribution where in a way we have consolidated and now we expect the market to reach lower. Imagine the same accumulation scenario, just inverted. So instead of manipulating the lows, here we are manipulating the highs. We are in a way, again, taking out these early sellers. And then allowing the market to reach lower. Probably we had a lot of people who were looking to sell it, let's say at these points where they got wiped out. A lot of people who were looking to sell it at these points and they also got wiped out. So the entire idea behind it is to take out early sellers, release liquidity to truly allow the market to trend properly. Again, an example of a distribution would be the USD JPY trade scenario that we have. This was from a little while ago, so let me put it in replay mode and jump down. I think it was a 5-minute time frame, if I'm not mistaken. This is now an example of a distribution in the market. And again, if I want to go ahead and mark this up based on the same schematic, we have our preliminary supply here. This is our buyer's climax to our sign of weakness following multiple manipulations of the highs, up thrust, and your up thrust after distribution. But again, I don't want you to look at this from a pattern trading perspective. I want you to understand why this takes place. We are taking out these early sellers to then allow the market to truly trend lower. Yet again, similar to accumulation, a distribution is validated once we break structure point. Now, whether you want to calculate the structure point here, or whether you want to be a little bit more careful with it, and let's say you identify this as your structure point, either way, once we start to challenge structure points to the downside, then we can expect the market to truly have its move. And again, we don't just buy and sell based on Wyckoff concepts. We do have other confirmations that helps us with entries to, for example, know where is the best place for us to enter the trade, for us to not only have minimal drawdown, but be able to have the smallest stop losses. Yet again, this is now an area that the institutions were distributing their orders at, or in other words, this is an area of supply. This is where supply was introduced to the market, hence resulting in this entire massive move to the downside from that area of supply. As mentioned, if you want to see more detailed breakdown of this distribution or accumulation, I would definitely recommend to watch the USD JPY and the GBP USD video. But as of now, I'm going to skip past accumulation and distribution to speak a little bit about re-accumulation. This is where a lot of traders get caught out because they might see potential distribution forming and they might have their markup as a distribution, but they still see the market go higher. They still see the market go against them. And now they're scratching their head thinking, hang on a second, I thought these Wyckoff concepts were meant to make my trading a little bit better. How comes I am still being manipulated out of my trades? If you find yourself asking that question, then it's definitely time to stop looking at Wyckoff from a pattern trading perspective and understand the entire market behavior behind Wyckoff. Within a reaccumulation, it starts off looking just like a distribution from your preliminary supply to your buyer's climax, all the way down to that sign of weakness. In a reaccumulation, we call that the shakeout, but all the way down to that sign of weakness. So far up until here, this looks amazing as a distribution. Probably a lot of people would be expecting maybe 1 or 2 manipulations of the high before this going lower. So maybe a lot of people were even looking at this as a potential UTAD, this as a break of structure to the downside, looking to sell it right at that line based on some type of an imbalance or institutional candle, just to see the market immediately go against you. Again, it's important to see the actual market behavior in terms of what takes place. If it's re-accumulating, then I should expect to see similar behavior to an accumulation. What did we say about an accumulation? A manipulation of the lows before we break structure to the upside. In a way, within this range, we weren't necessarily manipulating the highs. More than anything else, we were actually reaching below previous lows, manipulating previous lows, whether you want to put your support level over here or whether you want to look at these as minor supports and minor areas of liquidity. One thing trading Wyckoff concepts needs, and this is extremely important, is patience. You have to allow enough time for the market to develop and give you all necessary confirmations before you execute a trade. The interesting part is those who understand these concepts properly will tell you that patience is second nature. We don't sit here nervously looking at our charts waiting for an entry, because we know so long as we have the patience, the risk to reward that we look at will be phenomenal. So we don't need to execute a trade every minute of the day or every day of the week, or for that matter, every week of the month. Now, this is a general example of a reaccumulation. This automatic rally can be formed a little bit below the buyer's climax at the same level, or maybe a little bit higher than the buyer's climax. And oftentimes when your automatic rally is formed after the buyer's climax is where a lot of traders get very confused whether that is actually a distribution or a potential reaccumulation. Moving on to a redistribution example, this is again simply the opposite of a reaccumulation. At the start of a redistribution scenario, this can be mistaken with an accumulation. You have your preliminary support, seller's climax, this automatic rally back up, secondary test in phase B. So a lot of people would expect, for example, a spring and look to buy this to the upside. But again, it is so crucial to understand exactly where we are manipulating, where we are grabbing liquidity, which highs or lows are we reaching above or below, to give you further confirmation whether we are looking at a redistribution or whether we are looking at a potential accumulation. The idea behind redistribution is exactly the same as reaccumulation, but inverted, which means you tend to see a manipulation of the highs. And once we manipulate the highs, we tend to break structure to the downside and continue to break structure to the downside. If you find yourself analyzing this the correct way, yet still being manipulated out of the trades, it's most likely because you are way too eager to execute a trade. You have to, again, have the patience and allow the market to develop enough. A lot of people think if they don't snipe it, quote unquote, at the last point of supply, or if they don't catch it at the very high point of a redistribution for the sells, or very low point of an accumulation for a buy, that's it. The trade opportunity is gone. That's false. When you learn how to study the fractals, when you learn how to look at these same schematics on multiple different time frames, you will realize that within the same move, within the same markdown or markup move, you will be able to get multiple different entry points. And oftentimes the entry points that you wait for are those that allow you to have the smallest stop losses, which in turn will result to the largest risk to rewards. So what we have spoken about so far is very, very, very simple. We have broken down practically the only 4 scenarios that can take place in the financial market. We are either dropping and going sideways, and 2 things can happen from here. We're either going to go higher or lower. So it's either going to be an accumulation or a distribution, or we have a rally, then a zone of consolidation. From here, we're either going to go higher or lower. A lot of you now think to yourself, well, duh, obviously there are no more scenarios, but that's the beauty of it. We don't need to overcomplicate things. Understand that there's not many possible scenarios that can actually take place in the financial markets. You don't need to be looking at so many different methodologies and so many different ways to actually analyze charts when there's only 4 possible scenarios that can take place. And if you are able to find the areas of consolidation and identify the correct ones, then you are practically only looking at 2 scenarios. We're either going to go higher and lower. And again, some of you are still not convinced as to why this is so important. The reason behind it is very, very, very simple. If on a bare minimum risk to reward, I'm looking at a 1 to 3 risk to reward for each position. So let's say I have a 1 to 3 position for the buy side of things, and I have a 1 to 3 position for the sell side of things. This allows me to even be able to lose one of it, win the other scenario, and actually come out profitable. When you start to take away all of the noise, when you start to look at the market from a little bit more factual perspective, you will start to understand that a professional trader, and by professional, I mean someone who is or wants to take this on full time, would use whatever they can in their favor to always come out profitable. Risk to rewards and trade management being a massive part of this. And it goes without saying, once you get a better understanding of Wyckoff concepts, and once you get a better understanding of market structure, you would be able to identify certain behaviors within the area of consolidation to make you a little bit more certain whether we are going to continue to go higher or whether we're going to continue to go lower. So what we will speak about in part 2 of the Wyckoff introduction is how you can actually not only mark up each and every single point of the Wyckoff accumulation or reaccumulation and distribution or redistribution the correct way, but also be able to, in a way, tell the differences between a redistribution and an accumulation, or a reaccumulation and a distribution. Before we wrap it up, let's quickly think about the important points in regards to Wyckoff. We do not just trade based on Wyckoff concepts. It is not enough for you to open the chart and analyze it purely from a Wyckoffian perspective and expect to get correct trades and high risk to rewards. This is where many, many, many other concepts would come into play. And as I'm sure many of you have seen in the previous chart breakdowns that we have posted, we always utilize other confirmations before executing a trade. Another confusing part of Wyckoff is what time frame do I actually analyze the chart based on Wyckoff concepts? It's important to understand that the markets are fractal. And if you didn't notice it in this video, let me go through that very, very quickly. The GBP USD example that we looked at was on a 15-minute time frame. The USD JPY example for a distribution that we looked at, this was on a 5-minute time frame. The reaccumulation scenario that we looked at, this is also the 15-minute reaccumulation, and the redistribution scenario is a 1-minute schematic. You can see these concepts on practically any given time frame, whether it be monthly and weekly, or whether it be the 1 second and the 5 second time frame. So you can actually analyze it on any given time frames. But this doesn't mean you should go on whatever time frame you want, identify just an accumulation and a distribution and trade based on that. Top-down analysis is still important. consistent. You still want to see what the relative higher time frames are showing you, and if the lower time frames based on potential Wyckoff concepts are supporting that analysis. And the reason I say relative higher time frames is because you don't always need to start on the monthly and weekly and daily time frame before you execute a trade. The relative higher time frames based on what type of a trader you are. So as you're watching this, as you're waiting for part 2 of this video to come out, or before you go and watch the part 2 of this video, take some time out, go on your own charts and analyze Wyckoff and market structure and see what scenarios you can find. Try and look at certain areas of consolidation, look at the schematics and try and mark it up, then look at it from a manipulation perspective, whether we're reaching above the highs or below the lows, and the market structure. Are we actually breaking structure in our desired direction or not? Little by little, step by step, as you put in more hours and as you put in more time, this will become second nature. And whenever you open the chart, you will be able to see Wyckoff schematics everywhere. So as usual, if you got value from this video, make sure to press the like button down below. If you're new to this channel, press the subscribe button. Welcome to our family. Welcome to our community. Stay tuned for part 2. I'm still uncertain whether or not there's going to be a part 3, but I might end up recording 3 videos just to give a little bit more information in regards to what Wyckoff is and for you to be able to have a more solid understanding of how you can analyze the charts based on Wyckoff concepts. So with that being said, let's put in the necessary hours to study and learn these concepts. Let's be consistent, let's elevate, and let's catch these pips. Let's go.
All right. I know that was a lot to take in, especially if this is your first time being introduced to Wyckoff. The schematic itself, and I guess who he was as a trader. Do I have any questions over the video? So let's take a look at this on the chart. Here recently, all the JPY pairs have been moving up, right? You look at the market, it comes down. This is around 2019. We get a little accumulation. The market comes up, you get distribution. It comes down. You get another accumulation schematic. The market goes up. Comes up here, it distributes. It accumulates or reaccumulates, and it pushes higher, right? If you break these charts down, I think most of you probably look at the market on a 4-hour time frame. Am I correct? So if you think about the video that we just watched, this is a great example of an accumulation schematic, right? And if you pay close attention, the market is exhausted right here. This is, for all intents and purposes, the bottom of the market. Everything you see from this candle to this candle is manipulation, right? 1, 2, 3, 4, 5, 6, 7 candles of manipulation. The market ends up in the same exact spot, and then it takes off going higher. Gets here, reaccumulates, right? This is, the market is exhausted, it reaccumulates, they manipulate the lows again to run it higher, gets here, reaccumulates to go higher, right? So if you look at these moves on a higher time frame, this might be an order block here, right? It might look like a green candle, a red candle, and a green candle that goes up, right? Then you get a red candle and a green candle that goes up. Then you get a red candle and a green candle that goes up. But the lower that you break the time frames down, you can actually see how the market played out. So if you Google there are a number of these schematic. This is schematic number 2. There's a schematic number 1. But if you Google these and you print these images out, right, you don't necessarily have to know that this is preliminary support. You don't have to know that this is automatic rally, secondary test. You don't have to know any of this. Last point of support, right? The spring. You don't have to know the actual labels, right? If you don't want to get that in depth. But the important part of this is, let me see if I can get schematic 1. The important part of this is that you recognize that these lows are being taken out, right? Basically, the preliminary support is the low of the market. The rest of this stuff is just a play to keep taking out the lows in order to run this market up higher. The spring is the lowest point. Then you get a test, last point of support. All right. This SOS is basically a sign of strength, right? It breaks where your automatic rally was. It lets you know that the market is going higher. And your entry for patient traders is going to be right around the same level as your automatic support was. And then you'll take the trade higher. So if you look at this, basically you get the automatic rally here. Then you get these lows manipulated, you get the spring. And this order block right here, right? This order block for all intents and purposes, this is your trade at the same spot, right? The market comes right back, taps into the order block, and now you catch this retarded move to the upside from way down here. Just because you understood, how Wyckoff plays out. So why is Wyckoff important, to us in smart money, or anybody who trades smart money concepts? Some people just trade based off Wyckoff. I'm not one of those persons, right? But Wyckoff is important because it gives us a glimpse of the direction that the market is going to take, right? We don't have to guess, hey, is this market going to push lower? The Wyckoff plays out. We understand what we're seeing. I understand where to look for an entry into the trade. What if you missed your entry right here? Guess what? The market comes right back down again, gives you another entry. And you'll see, if you follow this series, he's going to point that out, that the patient trader is always the trader that's going to get paid. There are several smart money concepts that will overlap and allow you to get paid, basically. Okay. All this is a break and retest, right? The breakout trader, if you are a retail person, This is the breakout. This is the retest, and it allows you to take the trade higher. So if you understand that this entire move, right, is a break of structure, you're going to get a retest, and then you're going to get pushed higher. But before you get the break of structure, you get the Wyckoff accumulation playing out, which tells you that you're going to get a run up, right? Do I have any questions over the video that you watched, or anything that we covered today? So you guys are Wyckoff experts.
I have a question. I'm unclear on the accumulation versus reaccumulation.
A lot of people are. So, you know, at this level for you, it's not important, right? So an accumulation means the market is going to go up, right? Once the market goes up so high, it has to reaccumulate. You know, it has to collect more liquidity for it to push higher. Does that make sense? It's like you running uphill. All right, you can sprint for as long as you have energy, right? Then you tire out. You have to rest. You have to get more energy. Maybe you have to eat, whatever, before you can push and sprint the second leg. It's the same. The market is the same way. So this accumulation allows the market to grab liquidity from people who keep trying to sell the market, or people who have their stop losses. They're going long, but they have their stop losses here. They keep taking the stop losses. The liquidity grab allows the market to push up. Once it gets to this level, it reaccumulates. So they have to do the same thing again, right? They manipulate these lows to make people feel like the market is going lower. So even if you're a smart money trader and you're not careful here, you can get caught up in thinking, hey, I can trade this bearish order block, right? Here's a bearish order block. We can sell this. As soon as you hop in for the sell, you get liquidated. So it's all the reaccumulation is people being liquidated, right? People being taken out of the market. It's eye candy, you know, for people who want to go short. You know, if you keep that in mind, you know, there are several ways that you can keep from being liquidated. You know, the first thing here is this is clearly an uptrend. So if you trade with the trend, right, you're not going, you know, so stay out of going short. Some people want to be in every trade, and you know, for a seasoned trader, yeah, maybe you do go short here. But for beginners, or maybe even intermediate traders, why would you even bother, right? Why would you chase, even if you can get this whole candle, why would you chase these 75 pips when there are a million pips going up, right? So I think that whether it's an accumulation or a reaccumulation at this stage of the game, it doesn't matter. The more important thing is that you understand what's going on. So I think as a retail trader, you would say, man, the market is consolidating right here, right? And it's not consolidating, it's accumulating. You know, it's preparing to go up. You know, I don't know what we used to call this in Ruby's class, but maybe it was some sort of a flag right here, right?
Gosh, I forgot. It was
triangle or
yeah,
something.
yeah. It was a triangle.
Yeah, an ascending triangle.
So I just want you guys to to understand what's really going on, right? This is not an ascending triangle. This is something specific that's playing out in the market, right? So
Right.
if you're trading this, and then you get this wick that taps back into this order block, you're not wondering why you got liquidated because you jumped in the market up here for this long, right? You already know that we had a break right here, retest, right? So when you start understanding these concepts and you watch these concepts play out, then you stop guessing and you start understanding. Concepts will keep your money in your pocket, right? There is a concept that's built. This is Wyckoff, right? This is Wyckoff. Market goes up. What happens? It comes right back down here. Bam. Look at the pip count. Look at the pip count if you're a patient trader here. 261 pips. I want to say this is about a two-day trade. Yep. 2 days. In 2 days, 261 pips. Now I'm expecting this trade to go all the way up here, right? Based on the concept that there was a stop run, right? It liquidated these lows, and now you're going to get a run to the top side to take out this liquidity, right? But all of this is Wyckoff playing out. This is an accumulation schematic. Then you have to retest it. This is why the patient trader gets paid, because you get this spring right here, then you get a pullback, then you get the retest, then you get the run up. I made a lot of money last week on this trade. So with understanding, you can implement a game plan, right? So my first trade I took was right here. I caught this run up, right? I caught the pullback. I didn't catch the pullback all the way to this level. I caught the pullback to this level. Then I got out of it. But once it broke this level, I already understood that it was going to the 78.6. $78.6 on the fib. It lines up with the order block, the same order block that I took originally. And now I was able to basically double the pip count, right? And I took this up to about 19, I believe. So yeah, I got about 19 pips away from the top of this trade Friday. So I don't show you this to brag about my conquest, in the market. I want to show you some real life examples of why it's beneficial to learn these concepts, because once you see these concepts, you can't unsee them, right? Once you have an understanding of what the market is doing, it gives you options as to how you want to go about trading the market, right? ICT, who I learned a lot from, by watching his free videos, right? All of his free videos, I learned, more than I probably ever would have learned in anybody's paid mentorship, right? And a lot of the things that I guess, talk about and try to share with you guys came directly from the time I spent watching ICT videos, Pips of Persia, you know, a lot of different people in the way they break down their videos, right? ICT is a lover of this daily chart, and he loves whenever they do the stop runs on the either the swing lows or the swing highs. He teaches you that the market is about to run the opposite direction, and it does run the opposite direction. But he's like, don't sweat it. It's going to pull back to the 78.6. That's his entry, right? So if you recognize this move, you can catch those initial pips. But once it starts pulling back, then you can just plot the 78.6 and you can be patient and wait for it. And then take that trade to the top. Or you can trade it down. You know, the thing about trading it down is a lot of people are not as patient as they should be, and they're not as trusting as they should be. And all of that is fine because you don't necessarily have to be, right? The trend is definitely going up in this scenario. So you don't necessarily want to trade against the trend unless you understand the concept behind what's going on. So since I understood the concept, and this wasn't my first rodeo, I was able to catch this trade. So I think the last point that I want to share with you guys is at some point it's important that you guys learn how to hedge, right? Because even when you trade smart money concepts, you can be fooled at times, right? And you just might be fooled, you know, temporarily, right? But a hedge trade is the difference between you losing 8% or you making 25 or 30%, right? It doesn't necessarily always play out, you know, the way you think it's going to play out. So I want to encourage you guys to learn how to hedge. You'll hear me talk about hedging a lot. But that's another task that you guys should learn as traders, okay? And going forward here next week when we cover part 2, I think he might talk a little bit about hedging. Do you have any questions over anything that we've covered?
No, I'm just gonna probably rewatch. But if I have any questions, I'll bring them next week.
Awesome. Well, thank you guys for hanging out with me, and I'll see you next week.